Hello and welcome to this ABB Enterprise Software presentation, Tools of the Trade, a look at renewable development. This presentation will last 1 hour and telephones will be muted for the duration. If you have questions, please submit them through the chat or the Q&A window in your WebEx screen. Now I give you our speakers from today, Kevin Arnold, Content Manager, Velocity Suite Power, and Brett Toplin, Industry Solutions Executive.
Thank you, Dana, and welcome everybody. Thank you for joining us today. Like she mentioned, we're going to give a quick look at tools that renewable developers are using, typical steps that are being taken, and issues that must be accounted for to make good business decisions when we're talking about the renewable energy development and associated markets. This is just a disclaimer from ABB. As Dana mentioned, my name is Kevin Arnold. I'm the Content Manager for the EV Power Module here at the Velocity Suite in Boulder, Colorado. I've been working here for about 7 years, and I'm excited to share some insight with you guys today.
And my name is Brett Toplin, and I also work in Boulder, Colorado, and I work in a position that is really designed to use a lot of our tools the ways that clients would. So I definitely talk to a number of renewable developers out there, try to stay up on the news and follow different conferences as well. So hopefully between the two of us we can give you a lot of insight into the tools available for the development process.
Just real quick, here's what we're planning on talking about today. We'll just briefly go over the Velocity Suite, what it entails, why we're talking about renewable development, whether and how variable resources can impact build and steps that need to be taken, several tools that can help you to make decisions while you go through this, and then we'll talk about some pricing, transmission outages and constraints, hopefully get some feedback from you guys about what you would like to see, and then answer any questions that you may have. The Velocity Suite is a very powerful analytical tool. It's also a very trusted source for data in the energy industry. We have unrivaled data across dozens of distinct models. As my colleague Brett would say, we are the gold standard in energy information. You know, we have 19 of the top 20 generators as clients. We have 19 of the top 20 retail providers as clients. It's because we have an incredible breadth of data that we cover, and it really puts us in a unique position to give a presentation like this. And as always, if you guys see any charts or maps in the presentation, don't hesitate to contact the Velocity Suite and our customer support, and we can try to help you recreate anything that you've seen. So let's start by talking about why are we talking about renewable development? What is it about that makes this an interesting topic? Well, change in our nation's capacity and generation mix has been constant throughout our nation's energy history. This is due to new technologies, changing fuel prices and costs, and regulations at the local and federal level. All of these things can have a really big impact on build and our nation's generation and capacity mixes. If you take a quick look at what's changed over the last 20 years, you can see that there has been some pretty significant changes. Coal has seen a decreased market share for sure, decreasing from 56% to 34% here in 2015. Gas has replaced a lot of that capacity due to lower prices and technological improvements, but renewables are also playing a large role in making up for that lost generation. Renewable growth is approaching the astronomical limit at this point. We see a lot of investment, we see a lot of development, and we see a lot of results in added capacity. In the last 5 years alone, the available capacity from wind and solar has more than doubled. This is just a good representation of how solar and wind have been growing over the last 10 years or so. When we talk about renewable energy, one of the main things one of the first things that comes to mind for me is the weather. Due to the variability of renewable sources, weather can be extremely important. You can only generate from a wind turbine when the wind blows. You can only generate from a solar panel when the sun is shining. So it's important to keep that in mind as we look at this. In the Velocity Suite, we collect hourly and daily weather information. We also have forecasted temperatures and wind speeds. It's available at a level which allows you to narrow your search for siting and project valuation, trying to figure out where you want to build. While wind patterns can be somewhat predictable, the granularity of our data allows you to build out annual, monthly, or hourly wind shapes. This is a look at average wind speeds in Kansas from some of their major weather stations. And as you can see by these next couple of slides, there are some weather stations that have significantly higher average wind speeds than others. Being able to chart data like this allows you to search for and identify patterns in the weather, which can be important when you're trying to determine where you want to build. Both Garden City and Russell Municipal Airport, these two weather stations that I highlighted, have very high average wind speeds. And if you were to look at a map of South or Southwest Kansas, you can see that there are dozens of projects that are being developed in this area around this time. Weather is also important for solar developers. Solar irradiance and solar insolation are very important. It's a measure of efficiency, how much energy is coming from the sun and how much of it can be translated into energy. We are collecting daily solar insolation data from NASA, and it makes this data easy to visualize. Here's just an example of that. This is a visualization of daily solar insolation from the state of North Carolina and the state of Arizona. As you can tell, it's much more efficient to build solar in Arizona just due to the higher levels of solar insolation. But you guys didn't sign up for this webcast for me to tell you that it's windy in the Midwest and that it's sunny in the Southwest. So there are other factors at play that we need to talk about when people are making decisions in where to develop and invest in renewable growth. As you can see by this slide, we see a significant amount of build taking place in North Carolina, and we see a little bit less solar growth in Arizona. That seems to be contradictory to the graph that I just showed you, but we will go over some reasons for that right now. Renewable portfolio standards play a pretty large role in the amount of build that's going to take place. These standards and associated incentives are highly variable between states. Some only apply to investor-owned utilities. Most of them are measured by a percentage of retail sales that's coming from renewable sources. Others are measured by a percentage of capacity that's available. The state of Kansas measures their RPS standards via what percentage is going towards peak demand. In our federal government, states are really a breeding ground for policy and change, so it's important to be up to speed on your local regulations. Here's a look at the Arizona mandated RPS goals. They have a goal of 15% of retail sales by 2025. It applies to IOUs, investor-owned utilities only. They have an additional 86 regulatory policies or financial incentives in place in Arizona. If you compare that to North Carolina, you see that their goal is a little bit less in terms of a percentage, but there are a couple of big differences between these two that are leading towards more renewable development in North Carolina. Big one is the timeline. It's due by 2021 for IOUs and by 2018 for municipalities and co-ops. And that's the other big difference, is that North Carolina's goals also apply to municipalities and cooperatives. So the aggressive nature of the goals and the amount of regulations and incentives that are in place at a local level give a lot of benefit to developers in that area. The federal government also plays a large role in incentivizing build, so it's important to stay informed on what's happening at the federal level. Here's a good visualization of how plans can change with federal regulations. You see this is ahead of the expiration of the PTC in 2013. You saw a significant drop in the amount of planned capacity that was going to be coming online from wind development. When it became evident that these projects would not be able to come online by the expiration of that tax credit, we saw a drop-off and a lot of these projects got canceled. This is a trend that we see throughout national regulation. In expiration years, we see significant drops in installed capacity. The PTC, for those of you that don't know, basically it provides about 2.5 cents per kilowatt hour for every kilowatt hour that is sold onto the grid from wind energy. This is also a good time, I guess, to talk while we're talking about national regulations to give an update on the Clean Power Plan. The Clean Power Plan and the associated Clean Energy Incentive Program have been stayed by the Supreme Court of the United States. So states will not be required to submit their state implementation plans by the original 2016 deadline. Like MATS, which was also stayed by SCOTUS, we do see that some states are already beginning compliance. In addition to how local governments and how the federal government regulate in order to develop infrastructure and build, it's important to look at how the markets are regulating themselves. CAISO's EIM, or Energy Imbalance market, is a good example of this. Basically what it does is it allows for increased use of renewables, which are a variable resource, to meet demand when they would otherwise not be used. So it allows resources that, would not be used to be used. So once you have a region in mind, it's a good idea to review the competitive landscape of that region, and the knowledge of the infrastructure that exists there is going to be incredibly important. It's good to understand the extent of build in a region. This is a map showing new entrance projects in SPP. You can see by their project status that there are quite a few wind projects that are being developed, like I mentioned earlier when I was talking about wind, in the SPP region. It's also important to look at owner attributes, the status of a project, or anything like that to make sure that you're tracking other projects in a region correctly. The new Velocity Suite has a team called the New Entrance Team that will track any project from announcement all the way through construction into operation and even into retirement in order to help you make these decisions. Again, once you have a region in mind, it's good to identify the key players in that region. Because RPS goals are mainly based off of retail sales, it's good to know who is selling energy to the ultimate consumers and how much of it they're selling. Additional financial data allows you to take a closer look at the performance of these key players in the region. This is a cool chart that I put together on Kansas City Power and Light's total sales and their revenue per customer over the last 2 years. So in addition to who's selling, it's good to know who owns the available resources. Here's a look at some of the big guys in SPP. As you can see, AEP has a very large share of the owned capacity that's there. There are several other very big holding companies that own quite a bit of capacity in the region. In addition to looking at who owns the operating capacity, looking at who owns planned capacity can also be very useful. For many developers, these will be your competitors. These will be companies that you can benchmark against and help you make decisions that you need to make. So let's look at, a lot of these companies, if you take a look at it, are focused on wind development. As a result, we see a trend in SPP. I found this to be kind of staggering. 80% of all planned capacity in SPP right now is wind energy. I just thought that was pretty interesting, so I thought I'd share it with you guys. So after you've gone through these steps, it's important to look at PPAs. PPA is basically where you're going to be selling the power that you're going to be generating. By tracking unit power and purchase contracts in the Velocity Suite, we allow you to evaluate other contracts in a region by length, by capacity, et cetera, and you can use these to help benchmark against other companies that are in a similar position or to help distinguish yourself from others. after you've set up a PPA or possibly before, you're going to need to connect to the grid at some point. The Velocity Suite works very hard to enhance the interconnection queues that are published by all of the major ISOs, or independent system operators. Our entity backbone allows us to link specific requests for interconnection to units where possible. This is a good visualization of SPP's interconnection queue. You can see what type of fuel is expected to come online and when. Once you have a contract in place, EQR from FERC, the electronic quarterly reports, is a very useful tool. It can help you in the valuation of power purchase agreements. It can help you with benchmarking against like companies. In association with our LMP data or monthly plant production data, you can see revenue at a very granular level. Brett will speak a little bit more about the financial data later in the presentation, but for now I'm going to toss off to my colleague Brett Toplin.
Thanks, Kevin. So I think Kevin's walked through a lot of the history really well and what's incentivizing everything and at least a lot of the process that people take. I was going to cover a little bit more of the details into the financial implications of that. Some of those are listed here, but these are the big topics that a lot of our clients and other developers are looking at. It's project valuation and comparisons of those. Obviously, securing financing for these projects is a big deal, and for anyone who's gone and talked to one of those financiers or banks, they usually require quite a bit. Revenue projections is included in that, and not just for acquiring that revenue from the energy market, but also from those renewable energy credits. So there's forecasting for those. Power purchase agreements, as Kevin mentioned, those are negotiations and they don't just come out of thin air. You need to have some information for those. And then even post-PPA, so with these being long-term investments that may last outside of 20 to 30 years, the average PPA is probably within about that 20-year zone. So a lot of developers are also looking at what do you do for that post-PPA and your merchant activity. So we'll be covering some of the different tips and tricks that people use, doing a little bit of a deep dive analysis. By all means, this is not the end-all be-all, but I think it's good to cover some of these tools that are available. So continuing our study with Southwest Power Pool, we don't just cover SPP, but I think for our purposes, this is an interesting area. Specifically when you're talking about renewable development, this is right in the heart of wind territory. This and MISO just get a lot of wind development. But SPP is a bit unique where it also spans into that southwestern region, kind of the West Texas and into New Mexico area there. There's also a lot of solar builds that we're seeing in that area. So to start our analysis, this is the assumption that you've already found some type of siting. You're looking in different areas and you're starting to try and understand what are the financial implications of those sites. What we did is we tried to make something timely. So we took nodal prices from February of this year, and we took real-time prices since it'll follow the intermittency just a little bit more, and we visualized those by their location on the map. So these are all of your generator and load nodes. So by taking these, we're able to see a bit more of the congestion pockets that are occurring in the system. You see that we have prices fluctuating from anywhere into the negative range up to $20 to $30, and that's an average price in dollars per megawatt hour for the entire month. So if you think about that range, some of these can be very, very close pockets like the one that we've highlighted, which indicates probably what I would expect to be localized congestion. And I think this is important when you're doing this type of analysis because in addition to all those different things we just talked about on the last slide, you also want to know that you're not going to be curtailed. As Kevin mentioned, the sun's not always shining, the wind isn't always blowing, so when it is, you'd like to be able to generate and send that energy to the grid. If you can't and you're curtailed, whether it be physical or as a market indicator, it's good to know because it's going to impact those revenues. So zooming in on that region that we highlighted, now we're taking a look at the individual nodal prices and some of that infrastructure. And what I specifically think is interesting here is, again, those average prices that we have. We see a very, very tight window here along a 100 to 161 line there that's basically on one end of this, we see prices that are down below zero on average. And on the other side, we see prices more in the normal range of $20 to $30. And there's only 15 miles between these, so pretty significant difference in pricing here. Now to kind of beef that up and throw in more of the information that Kevin was talking about, we basically stayed in the same region, but we're just applying a new heat map that better visualizes the difference in pricing. And that allows us to take some of those prices off the price nodes and keep the map from getting too busy. So still looking at this congestion, it's pretty interesting. We're in an area in really central to northwest Kansas. We're not talking huge load zones. We're also looking at a number of projects in the area, but a lot of different things happening with those projects. So a few of the things that I think are interesting are up top there in the top left, we have a proposed wind facility. That's Ringneck Prairie Wind. And what's interesting about this is it's on the side of congestion where it may actually help to alleviate a lot of those high prices. But if you look around the other areas of the zone also, there's a number of cancellations. So any of those circles with an X are going to be a canceled project. And the interesting thing about that is with so many cancellations for wind facilities in the area, Ringneck is actually permitted, which it's looking like it's going to come online in early 2017. So that'll be an interesting build here. And that goes back to what are your competitors doing that Kevin was mentioning. The other piece to this that I think is interesting is you do have some gas in the area that's taking on some of the load, but it's kind of a little congestion pocket that's moving here up into the northwest. So when we visualize that pricing on an hourly time frame, now we're again looking at that February window, but we're looking at all those individual nodes on a chart. It's very, very obvious to see the congestion, and you can see the spread that we were talking about in that different area where we have prices skyrocketing as high as $500 for a megawatt hour, and on the other side of that constraint dropping down to below negative $250 for a megawatt hour. Being on the right side of this constraint can really help the lifespan and the revenues of a project. So when we talk about this congestion in the ISOs is measured via shadow prices. And this is just a way that I like to start looking at congestion and then drill down to better understand it. What we've basically done here is taken all of the individual binding constraints, so that would be a flow gate, which is made up of a monitored and contingent element. So those are pieces of the infrastructure. And each of these binding constraints has a monetized view of the congestion that's happening on the system, and that's really a shadow price that they assign to these different constraints. Shadow price not only shows the magnitude of the constraint and needing to move energy elsewhere, but it also has an impact on the nodal prices that you'll see. So to kind of take this on a simplified view and then drill down, I think that what a lot of people like to do is they like to understand what is the constraint, why is it occurring, is this something that's happening regularly or is it something that's a one-time view? And that helps you determine, is this an area that's still valuable to build in, or is it potentially an area you want to avoid for now? So as a simple starting point, a lot of times what I like to do is just take all those different flow gates and take those shadow prices and just run a simple correlation against the prices in the area. And so this is what you see with taking all those different constraints. They have somewhat of a cryptic name in there, but we'll outline a little bit of what they cover. And we have their correlation that's tied back to the prices. And I think what's important to note with this is one of the things we're really interested in seeing is the strong negative correlation. Both a strong or negative or positive would be valuable, but when we're talking negative correlation, that ties back here where the shadow prices are reported as negative values. So when you have a very low negative value and very high LMP prices, that's going to give you a better indication of something that's really driving up congestion in that area. And so this, again, to note, is a correlation between that shadow price and the congestion component of an LMP. And so I see a few that are jumping out here that are pretty interesting. First, these probably aren't having a major impact, but I think it's going to highlight why you're going to want to do deeper analysis beyond just correlations. But when you look at this, we're seeing a few of the, I guess, stronger reverse correlations coming from some constraints on 345 kV lines. So you have a couple different lines here, and I've highlighted basically some of those substations on the 345 infrastructure. The reason this is interesting is because they do seem to have somewhat of a negative correlation to the prices, but we're talking significantly farther away. Even though it is moving larger amounts of energy, I wouldn't expect these to be the dramatic influence of those prices that we're seeing in the area. And you can see that when you start charting these. So this is kind of an interesting concept, and it won't really make sense until we hit our point home. But what we're doing with this chart is we're essentially mapping the hourly shadow price from one of those constraints versus the hourly congestion component from those nodes. And this is another way of tracking some of that correlation. So what you're noticing with this is even though those were more closely correlated from just a simple equation, a visualization will show that this constraint really has little impact on these overall congestion in the area. And that takes us to the more localized congestion. So when we start drilling into this, I noticed two others that have a very strong negative correlation, which really means that those shadow prices are driving up the prices of congestion. And that's our line from South Hays to Hays for the loss of POSTROCK-KNOLL. So I'll go through that again to make sure everyone's familiar with these constraints and how they're measured. Generally, they're going to be reported in some fashion that's going to identify a line or component of the infrastructure, and it's going to have some name, whether it be the full name or a shortened name of potentially the substations of the facilities that are involved. So that first one in the top left, we basically identified that POSTROCK-KNOLL, Hays, and South Hays substations, and those are going to be the constraint that is making up some of those shadow prices we're seeing in that area. And you see it's got a very, very strong correlation of negative 0.86. What this is basically saying is that Hays to South Hays section of the line is becoming more constrained because of some type of issue happening on the POSTROCK-KNOLL area. Now, the other piece of this that's interesting is just a few lines down, and that's the one that really looks like a gobble of language. But what this is saying also, and you can actually find this in SPP reports, is South Hays to Hays for the KNOLL transformer. So that XFR is your transformer. And I've highlighted that constraint on the other side here. So it's again South Hays to Hays, but this one is specifically because of overload on that KNOLL transformer. And these are interesting because these are right in that area. If you look in the top right map, these are right in that area where we're seeing a lot of our high congestion prices. And I think this marries the analysis between visualization of data and really crunching the numbers, and I think both are valuable when you're doing this type of analysis. And so to really dive into just the last pieces of these, so this is that South Hays to Hays for the KNOLL transformer. Even though it has a strong correlation, bringing it back into our visualization of that shows that it's really less of an influence. Just despite all the zeros that we would see in their shadow price reporting, it may throw out somewhat of a false positive. But when you look specifically at our South Hays to Hays for the loss of POSTROCK-KNOLL, this is where you really can start to see that correlation, and you can really see that there's more of an impact in here. So certain constraints, even though they may have a stronger correlation, actually need a little bit more of a deeper dive to see what kind of influence they have. And that brings up another method that we're not really getting into detail here, but there is a congestion modeling technique that is basically looking at a magnitude of a constraint's impact on different nodes. It's called the distribution factor, and what I've put in here are some values that are more or less modified and simplified distribution factors. I wanted to take more of the constraints and see how much of an impact those constraints had on our congestion prices. But this is where you can really see the difference between, even though we had a strong correlation across all of these different modifications of numbers are actually showing that there's a much more significant impact from that one specific constraint. So, moral of the story, why is this area congested? And that's kind of the $1 billion question that pops up a lot. It's not always easy to answer, and a lot of times there always won't be an answer. So it can be tricky to actually figure out what's happening. I would say if you ever run into issues with this, dive into a lot of detail, but you can also look for reports that are posted by the ISOs. So ISOs always do a great job of tracking their congestion and what's happening on the system as well. So what I'm noticing in this area is that in a lot of the reports, they're basically identifying that this KNOLL transformer is just becoming overloaded. A lot of it, even though we have low demand in the area, it's just coming from just too much demand for what what's actually needed in the area. So I wanted to look at what's the demand been like in February. So this is a chart of temperature, basically our temperature over the last year, and our daily demand, our average daily demand. And so what you're going to track is, obviously when we have higher temperature, we're seeing some higher prices being in the south region here, but when you see that temperature dip down as well, we start to see some of those higher demand numbers. So to drill in a little bit more to our February time frame, we have a year-over-year chart in the top left and a daily chart in the bottom right of basically our temperature, our normal daily temperature, and then the heating degree days. So being a winter month, when we have a heating degree day, we're seeing people kick on those heaters because it's cold and we're expecting to see more of a demand rise. The big takeaway here is that February temperatures were actually a lot higher than they've been historically, and that's what you see in the top left. That average temperature, which is going to be the green bar, is much higher for February of this year compared to February's of last year, and the heating degree days is much lower. So in theory, this should really relieve demand in the area. And what that ties back to is this a one-time event? Are we seeing some sort of spike in demand? Are we seeing an outage that's causing this? And that's where I like to pull more aggregate values for this type of analysis. So in this aggregation view, we've taken some of those more highly correlated constraints to our prices, and we've charted them just based on their frequency, basically a record count, and that is in 15-minute intervals, and our average shadow price over that time. And I think that this is useful as well when you're analyzing this type of impact, because it's going to let you know the constraints that don't hit as often but hit very, very hard with high prices like the one on the far right. Or it's going to let you know some of those like our South Haze to Haze constraints, which are the second and the fourth one, that don't necessarily have high shadow prices all the time, but they're hitting very, very regularly. So if you were to look at this, combining this with the lower temperature and the lower demand that we were seeing, I would basically expect that this area is just regularly overloaded, and this would be a great spot to be that new wind farm that's maybe alleviating some of the congestion. Definitely not a place where you want to go on the other side where you're going to be curtailed potentially. Now, I mentioned outages. We're not going to go into a lot of detail for outages, but I do think that this is another component of the infrastructure. It fills in a lot of the pieces of the puzzle, and it's definitely a useful component of this. We also track all the outages that are reported by the ISOs, and so that could be anything from scheduled to actual, and it will let you know what's an emergency or a forced outage or something that's just scheduled on the line. And then we do a lot of data analytics in the background to let you know frequency, again, like the record count you're seeing here, or the overall duration of these outages. And that's, again, just another piece of the puzzle when you're actually diving into these areas. It can help you identify constraints, but it can also let you know areas where, again, you may be able to alleviate some of the spike in demand in an area that's regularly seeing an outage. Or it might let you know an area that you don't necessarily want to build because there's a regular outage there and you won't be able to get energy out. Now, the historic analysis is very useful, but I always like to highlight that just because we have historic constraints, that may not actually indicate something in the future, and I think that's valuable in this chart. So each of these identified substations, so these are all different substations that are yellow now with a ring and they've actually been labeled. These are all proposed or upgrade substations that have happened recently. So we are expecting to see some infrastructure upgrades in this area. Some of these upgrades may have actually canceled just because they were tied to wind projects that are no longer existing, but it's definitely something to be aware of. So to shift gears now, say you found your area and you're just trying to get that financing and you want to know a little bit more about potential revenues or project valuation. This is when using a hub basis can also be really useful. Hub prices are a great indicator for market trends, so where you're expecting to see prices go in a more aggregate view. But using a basis of your node or your area versus that hub also gives you a very, very good view of localized trends in relation to the larger scale. And really both of these are helpful because they let you measure risk on a longer term on both a macro and a micro scale. And so using, again, this historic data from Velocity Suite can really help you with this. So on the left side, we're looking at hub trends, and on the right, we're looking more at that basis. And this is valuable when you tie back to, say, the production tax credit that Kevin was tracking. You can see, is this basis significant enough that you wouldn't be able to recoup a lot of the costs? or by leveraging that PTC and then a lot of the generation, maybe a higher capacity factor in the area, are you able to make up a lot of those costs? A few other tools. These are some of those when you start getting more and more to those data nerds out there, like a lot of us here in Boulder. But starting to look at the data in different ways and slicing and dicing it can really help for this type of analysis as well. I pulled a screenshot here from this energy markets, basically this renewable energy markets PDF that I've listed at the bottom. But they go into some great details about siting in this process, but also they have this great chart that's basically looking at bucketed values versus different prices. So when you bucket data, you can also get some nice trends, and it helps you take a lot of data and push it into something that's a little bit more palatable. And then as you get a little bit more, I think we're seeing a lot of advancements in wind forecasts, both day ahead and longer term. And obviously the expectation of solar is a little bit easier just because you have a pretty good idea when it's going to be sunny and when it won't. Looking at the day ahead and real-time spread becomes more and more important as well. And again, this is all data that is available in Velocity Suite, and I've highlighted some of that in the top right. So these are all the things that are going to help you determine that you'll make more money, you won't be curtailed, especially wind in this area. When we're looking at Kansas, there is a lot of curtailment, and it's not necessarily something that you can be ahead of. It's something that may just happen at times. So what I've basically taken here is the congestion component of nodal pricing for various wind units in Kansas. And you're seeing all of the negative congestion values, which are not necessarily an indicator of physical curtailment, but these are going to be any of the market signals where the pricing is saying that they don't want as much generation as is available. So it's good to be able to track this information. It's another tool to add to the kit here. And when you aggregate those curtailment values, this is pretty significant. So if you were to be generating at these times for each of these hours where these were curtailed, this can have a really significant impact on revenue for these individual units. You can see that averaging this over that time frame, we're seeing in the $30,000 to almost $40,000 in losses range. And one of the last pieces that I think is also tied in, since we are making these investment decisions and they're long-term, spending a lot of money is a lot of folks will take that hub basis or that hub trend and some of the other values that they're looking at, and they'll apply that to a forward curve. And what that is it's basically, forward curve is what the market would pay for something in the future today. So it's a little different from a forecast, and we'll highlight that. But it's basically what most people are using right now. It really helps you kind of track the volatility in the spot market, so that's why these are developed. If there's a lot going on in the current spot market, having a forward curve gives you a little bit more insight into the future. It's really useful for determining seasonality from a lot of these patterns that we've looked at historically, especially in the energy market. There's a lot of volatility. So when you look at something like this, you may not always want to use an exact curve. Sometimes using ranges can be valuable. But again, the main point here is a forward curve is not a forecast. And while a lot of people do use forward curves, I think that there's equal, if not more, value that comes from a forecast. And a forecast is an actual future simulation of the market that's going to calculate the expected prices. And so something a good forecast would take into account is the new build activity, retiring units, proposed units, different regulation built out for like RPS standards. And it's going to give you a very good indicator of what prices may be long out into the future. So I pulled in a few snapshots from our reference case. So we actually have a team of folks that are very, very specialized in different areas of the energy market. It's the advisors group. And I like to steal their slides for this type of thing because they do a lot of the dirty work of digging through this data that's provided from the Velocity Suite and running it through a number of models to get their own forecasted prices. And while we've cleaned these up because we don't want to give away the farm here, we've taken away a few of the axes, but you can start to see some of the trends that are included in these. So they do a lot of different forecasts with a number of different scenarios, and what we're looking at right now is basically those different forecasts based on what would happen if we saw high prices or low gas prices, the clean power plan as an example. And I think this is another valuable indicator of where you're expecting those energy prices to go. Now, as we mentioned at the beginning, you're not just going to be pulling energy from those energy prices, so you won't always collect that revenue there. Having some sort of idea of where RECs are going, or these renewable energy credits, which are basically a way to add value into the RPS. It's also good to know what the cost for these REC prices would be, so having a long-term forecast for that is equally as valuable. And the last slide here is just some of the other things to include in both your historic and your long-term analysis. I think that a lot of people in the renewable space are saying, well, it's economic, let's build, it's easy, we have these incentives, it just makes sense. Longer term, with the competitiveness and anything else that's going to be factoring in, you're going to want to track some of those pieces that aren't directly tied to renewable development. Some of those would be gas prices because, as Kevin mentioned, gas is such a significant piece of the energy market now. But then also regulation that we're seeing. So even with the Clean Power Plan being stayed, MATS has been resubmitted, and we've seen a number of coal retirements based on MATS even before it was taken into account. So a lot of these different regulations are really having an impact on the generation mix. They're reducing the coal fleet. They're pushing for more gas, but also more renewables. But everything's really connected. And so having an idea of where these are going to go is also valuable. And I pulled these again from the reference case, but some future gas prices, which are helpful to track, and some of the CO2 dollars per short ton prices, which again will let you know different areas that may or may not be impacted more by some type of regulation. So lots and lots of tools. Hopefully we didn't overwhelm anyone, but I think the value is there, and we're happy to talk in more detail. Before we wrap up, I think that Kevin actually had a question that he wanted to pose for folks.
Oh yeah, thanks, Brett. You know, at the Velocity Suite, we're always looking for ways to improve. So we'd like if you guys could take a quick moment to give us some feedback. You know, have we missed any important steps that are being taken by developers? What additional tools would you like to see made available? And what enhancements to the existing data would help you guys make decisions in your, day-to-day operations? This is very important for us, and, like I said, we're always looking for improvement. So any way that you guys can give us feedback would be useful for us in terms of helping us to improve the quality of the data and the Velocity Suite in general. We would like to take this opportunity to answer some questions from the audience. I think that we have already received a few.
Great. And once again, if you have any questions, feel free to submit them to the chat or the Q&A window in the WebEx screen. First question is, came a little early in the presentation. Where does the power purchase agreement data come from?
The power purchase agreement data is going to come from primary research mainly. The dedicated new entrant staff at the Velocity Suite does due diligence anytime something's coming online or to find any PPAs that exist. So it's going to be done by primary research mainly.
I guess a similar question is, not all the proposed capacity shown in the slides are going to come online. How frequently are you updating those projects?
Often, very often. Like I said earlier, we have a dedicated staff of a new entrants team that makes sure that they do their due diligence. We're constantly monitoring, utility websites, federal surveys that are coming out to update ownership information, project statuses, project plans, and things like that. We do our best to stay on top of new entrants data because it is very important when you're analyzing infrastructure and using it in your models.
Great. In regards to the forecast data offered, how long are the forecasts for, and can you give a more detailed description about what's included in the reference case?
Yeah, so the reference case is a 25-year zonal fundamental forecast. And what that means is, since we are going out 25 years with that, you don't want to take it too granular and you don't want to have anything that's necessarily nodal. While we do have nodal forecasting as well, it's a little bit longer term, so the zonal piece of that. I mentioned a little bit of it, but the reference case comes with a number of sensitivities. So there's going to be usually a high and low gas, a few different environmental and obviously the base, and it's changing every 6 months. So that team is rerunning their models and putting out a new reference case based on what's happening in the market every spring and every fall. In addition to that, a lot of the data from Velocity Suite that feeds their models will also be forward-looking. So whether it's short-term like forecasted demand or forecasted temperatures or wind speeds, a lot of Kevin's new entrance data and that team's work goes out far into the probably 2030s, 2040s, even farther.
And then from your maps, how granular is the transmission infrastructure you have available?
The transmission infrastructure that we have available, we go down to 69 kV, but most of what you're going to be able to see and what we're going to have really good data for is going to be 138 and above. That's where we're going to put in most of our efforts.
Great. Looks like last question here, I can take this one, is I saw you have EQR transactions allocated to a specific wind farm. Are all EQR transactions related to a specific fuel? For that, EQR is really reported at a company level, and so when we're able to assign the fuel, it's most likely that the company that was created really only owns a project that's correlated to that fuel. Most of the time, the respondents are going to really have different projects, multiple different fuels, or a power marketer that doesn't own any assets. So in those cases, we wouldn't be able to assign a fuel. But we have a really deep entity relationship structure that relates all of the different reports into one single entity, so that you can at least get a relative price by fuel in those areas that might not be available.
Is that all the questions, or are there more anyway? If there are questions that come up offline, we're happy to address those after the fact too.
Yeah, I think as of now we're good.
Okay. So yeah, thank you everyone for joining. We did want to show you a cool site. It's free. It's energymarketintel.com, and we'll definitely be sending out a link to this so you can see it in the bottom of the screen. But it's a great website that a lot of the different groups within ABB and EPM are putting up content. So we're doing anything that's new to a product or anything that's new that we find goes in here, as well as a lot of the different blogs and white papers that we do from our own analysis. So we're tracking all different components of the markets, and we're always doing different points of analysis. And if you want to see what's new, this is updated pretty regularly.
Right on. Well, thank you guys very much for attending, and we hope you guys have a great day.